Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do, see what the news is. It's mainly going to be related to three topics, mostly commodities, financial topics, and or wealth building areas. I'm going to interject my financial opinions as we go. I'm not going to be right on everything, but hopefully I can give you a little bit different viewpoint as we go through this and add to the opinions of other people's opinions and what they're seeing in the markets. I actually find that there's a lot of value in this because it is basically consolidating a bunch of different people's opinions, and it may or may not catch things that I don't see in the market too. So hopefully it gives you a well-rounded opinion on our current status of the market. And a lot of the stuff I share, it is biased to some degree because I'm the one filtering it. So keep that in mind, is that I do have my own proclivities to following certain channels that think similarly to me, because I think that is the way that people should think about the markets. So let's dive in. Let's take a look and see what people are sharing. If you want to follow me at Finding Square Finance on Twitter, and if you want to join our community, we do have a coupon code called LEAP going on right now because it is leap year. I don't know if you guys know that. 29 days in February. So there is that. Finding finance. Somebody's calling me out. This is too fun. How about NVIDIA overlaid on PBR? Well, it's really PBR overlaid on NVIDIA, but PBR is the white one. What I see there is a distinct pullback, one hump, two hump, and then the third hump. And we're basically breaking out of that to the move to the upside. You can see that this also had three humps in NVIDIA and the red orangish line, however you want to call that. And then we had a consolidation move where it consolidated upward, much like energy service stocks are doing right now. And then we're going to get a big move to the upside. The thing that's going to occur, I think, is that NVIDIA and some of these other larger corporations are going to hit a headwind when oil starts to run. They threw everything in the kitchen sink at oil. They threw SPR barrels, strategic petroleum reserve barrels on the market. They raised interest rates as fast as they could, the fastest rate hike in to slow it all down in terms of credit expansion. They were successful in doing so, and maybe we get a slowdown that occurs from all those rate hikes, maybe a liquidity problem. But the problem is the way that they solve a liquidity problem is with more liquidity. If they inject liquidity into the markets and we're this tight in the oil markets or the energy markets in general, I think it's going to really stress the energy markets and it's going to push prices way up. So, yeah, I do think that this fractal, we call it a fractal repeating pattern over time, will probably be something similar. Mm-hmm. So, Peter Pan or Petey Pan, yeah, I agree. Nugget Capital Partners says this is why we started to buy nat gas stocks. Some exploration productions will struggle to get drilling permits as there is going to be water bans plus First Nations issues, and $2 naturally is going to cause curtailments. By 2025 year end, more LNG set to arrive, which could cause futures to rip. He's got it perfectly right. There's a lot of stuff coming actually in 2024 in America. And I think they're building an LNG terminal up in Canada as well at some point. And at prices where we are today is going to set up a gigantic bull run in natural gas over the next 18 months, 12, 18 months. So this low price is what's needed to flush the market of inventory. And it could take some months. So just be prepared and get ready. We're at very cheap prices. It's under $2 in ACO pricing up in Canada and also in Henry Hub. Here's oil energy update. This is what he thinks could potentially occur, which is a pattern where we can work our way on up in this bowl-shaped pattern. It is basically a double bottom. It'd be bottom one, bottom two. We call it the booty bottom. And we could break out of this thing and run all the way to the $100 up in 2024 even. Middle of the year 2024. I agree. I think that this is very much a possibility. Will it play exactly out like that? I don't know. We'll have to wait and see. But I'm very bullish on oil. The gold to oil ratio is real cheap. at the current moment. We're in the upper 20s, and we've got a long way to run in that ratio. So we've got a long valuation runway that agrees with a lot of the technical analysis that people are doing. Kevin says, but to be clear, I've said, I'm saying that the market will look beyond this, and because CCO is so big, and in all the ETFs, it will likely keep going up, probably to $200 a share before the bull is over, simply because investors are dumb and fund managers like Cathie Woods like to play momentum. Westinghouse is a complete unknown as far as its ability to generate profits. So people will just assume that all this will work out in the long run and profits will eventually come. On the positive side, they can add reserves and resources and extend mine life. So even with terrible short-sightedness, somebody should be fired contracting. In time, it will see big profits. But with the amount of pounds sold in the last few years, it seems like it's going to be a long wait for that to happen. He's talking about Cameco and how they contracted a lot of their pounds at lower prices. And if they can't produce pounds and they have to buy off the spot price or spot market, they could lose some money doing that with some of their production, which isn't the best of situations given how big this bull market is coming in uranium. So here's Patrick. I like crude oil. I like crude oil charts. I like people who post crude oil charts. Is everybody still thinking crude oil is dead? All that has been happening is more coiling above a long-term breakout line. And that's exactly where I think we are. We are coiling up on top of a support level, and it's going to break this thing at some point and run like a beast. You can see all the massive volume support nodes that we've got, that he's got these lines running across here. Those are all big support levels, and we're right on a support level right now. And that's what we jumped off of today, is that support level. Or yesterday, I should say. Scrolling down, if someone wants to sell a large amount of uranium in the spot market, will be a buyer, Cameco. I just thought that was funny. Had to share it because they are short, given some of their contracts on their production. They have to buy in the spot market. Big Oil's blockbuster 114 billion investor payout is the most ever, according to Bloomberg. Cash return was 76% higher than during the $100 a barrel era. Executives are ramping buybacks to lift low stock valuations. The cash flow that a lot of these oil companies are generating and the dividends that are being paid out, it's like cheating, guys. You're playing this game on cheat mode. You can sit in these things. You've got a bunch of upside potential where we're buying it today, and they're paying you to sit in it. And a lot of them are doing share buybacks, which will eventually really push the share price to the upside, especially if we get a move in the oil price. So they're doing everything that's shareholder friendly. They're basically inviting you to buy their stock, is what they're doing, and by what they're doing with the share prices. Success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. And there is a couple of things that I think you have to get either experience in or able to control emotions. You're going to have to be able to ride through some volatility. What is volatility? 20, 30, 40% market moves at bottoms. And that is basically as close as you can get to the bottom with the majority of purchases. Some people think that they can, well, what a lot of people will do, and I'll just do a quick paint discussion here. I'll just draw it on here. What occurs is if a stock's in a downtrend, it's downtrending like this, and then it bottoms like a double bottom, you can buy it. What a lot of people do is they wait. They'll get some sort of pattern here. They'll buy it up here and say, oh, this is less risky. I didn't have to ride through any emotional volatility. What I do is I'll buy maybe the right bottom here, or maybe it's an inverted head and shoulders. I'll buy it all through here, sprinkling money into it, and then I'll put a big chunk here. So yes, they didn't have the emotional toil of going through this up and down movement and riding through this volatility. But I also got a really low average price maybe down here versus their price up here, and I make maybe 3x more money or 2x more money, 2 or 3x more money. So that's kind of what I'm doing. And I'm using ratios and market conditions. I'm really relying heavily on that, not just technical analysis. But I can also see it in technical analysis. You can also buy lagging companies, not the leaders. In my career as an oil and gas analyst and energy fund owner that spanned decades, I don't believe I've ever seen such apathy towards quality oil stocks when oil prices are not only strong, but are experiencing a strong rally. Nevertheless, I remain convinced that this is temporary. I agree completely. I think it's a huge opportunity in some of these sectors. Stanley Druckenmiller, what he says, quote, I literally sold the top range in the 1999 tech bubble, but it went up another 30% while I was in cash and was tired of seeing stocks up. So I couldn't take it anymore and I got back in. Little did I know I bought the top and lost $3 billion that year. That's your symmetry. You don't want to chase stocks just because they're going up. Some people will say, oh, well, NVIDIA is outperforming X. It's like, guys, your risk reward isn't there. It's all downside risk with very little upside left. So that's the way that I view it. And I'm glad that Stanley shares his mishap that he had in 1999. And you know what? It's going to happen to a lot of people, especially those with a lot less experience than Stanley Druckenmiller. I was just in Washington, D.C., and interesting to see the trainloads of coal coming from West Virginia and Kentucky into Baltimore Harbor to be shipped to Germany. That paragon of green energy. Yeah, that is ultimately weird because they tried doing all this green energy and all of a sudden we're shipping them a bunch of coal. How weird is that? We find doing nothing the most difficult task of all, says Warren Buffett. And I think that's probably true of everyone. The doing nothing part is the most difficult task of all. And sitting in a position and having it make you money is the hardest part. And I know that sounds weird because some of the times it's not making you money and you have to ride through volatility. Global oil inventories are set to shrink by 1.6 million barrels a day this month after a shallower than normal build in January. We're eating through inventories, guys. It's going to continue to eat and eat away at the buffer. And when people get really weirded out with very little inventory, that's when prices are really going to move. And it's going to be it's going to be hard to turn this thing around. We've got low drilled uncompleted wells. We've got underinvestment in energy service. I mean, we are going to have to drill like heck to catch this thing back up. He says, I give up. BTU Coal, 724 million in free cash flow on a 3 billion market cap, down 5% on results. ARM, which is AI, 724 million free cash flow on a 100 billion market cap, and it's up 45% on results. Yeah. The value's over in coal, but I don't know what the growth rate of ARM is. I didn't look at that. Like, I don't know if it was coming from like, 200 million free cash flow to 724 to 1 point something billion, maybe. And maybe that's why it's up, but that I don't know. Kevin Bambro says, do I read this correct that every $5 rise in the price of uranium above $91 a pound costs Cameco $49 million in negative cash flow? Nice contract book, LOL. Yep. The tech bubble, just as in 99 to 2000, herd chases tech into the stratosphere at expense of almost all other stock segments, especially value stocks and gold. Then it all reverses. Tech stocks plummet, investors pile into gold, and from late 2000 to late 2003, Kiwi gold stocks soar 600%. I agree with this right here. Fred Hickey's definitely on it. And that's what's going to occur. Tech is in a bubble. It's going to get overextended. And then the money's going to rotate into commodities and gold. The question is when. I don't know when. But guess what? I'm not going to buy something that's overvalued. I'm going to go buy the value stocks that are undervalued that nobody wants. And then I just sit and I wait. We find doing nothing is the most difficult task of all. And that's exactly what I'm doing. I'm sitting and waiting. In 2007, Bannerman was at $20 per pound of valuation. It's $1.36 today in terms of the valuation of pounds in the ground and what it's being priced at. So it's the enterprise value divided by how many pounds they have. It says we didn't have uranium shortage then. We have at least 5 years of a shortage now. And someone says, well, what about this share dilution and all that? That's accounted for in the enterprise value divided by your pounds. And then it's going to be distributed over that thing. So it's going to be your enterprise value. So your enterprise value to be equivalent to 2007 pricing needs to go from $1.36 to $20. Your enterprise value and your share price, as long as they don't dilute more, would be 20 divided by 1.36 of 14.7 times upside if the valuations were to be the same as 2007. And you could debate that the debate could be held around that valuation. Maybe it will be valued even more because they're going to be closer to a producer because it is a developer. And since it's closer to producer, they might gain even more valuation per pound because it's closer to production. And generally, the closer you get to production, your valuation changes to account for a higher valuation per pound in the ground. But that's last market, and they didn't have many pounds in the ground last time. It was a more speculative stock. So now, I don't know. I mean, what if the price of uranium goes double or triple the peak of last market? So what if it goes to $400 or $500 a pound? What does that valuation look like? So, I mean, if I were to value it that way, we can do a little bit of math real quick together. So 140 divided by 20 was the multiple. So it was basically divided by 7. So if we go to 500 a pound divided by 7 is a valuation of 71.42. It's the same percentage. And then you want to divide that by 1.36. That's 52 times higher that we could go if uranium were to go to $500 a pound and the same valuation metric in 2007 were to hold true. It would be a massive move to the upside. I am not stating that that will occur. I'm just playing with numbers to give you guys an idea if the valuation was the same and we got a $500 a pound uranium price, that is possible. I'm not saying that that is a projection. And that's what I've got for today, guys. So give me a thumb up for the content. Give me the thumb up for the content. And again, that's not my projection. I just wanted to share numbers. But that's what I've got for today. Everything looks pretty good for commodities. And all of the data supports higher prices. So that's what I've got. We'll catch you next time. This is Finding Value.